You that is watching this video have lived through the worst stock market in over 50 years, and it could shortly be coming to an end. Yes, we are talking about a bullish reversal, but there is the possibility this could get much worse. So we're going to go over those two possibilities. Do we rally? Do we crater throughout the rest of 2022? First, we have the bearish case, which is pretty clear to see. Contrary to popular belief, it does not matter what the Fed does. It does not matter what happens in the economy, relatively speaking, as long as company earnings remain healthy. And a matter of fact, we will have the first round of large companies, including Tesla and Netflix, reporting earnings in this next upcoming week. And the bearish case is, if these companies miss earnings in a dramatic way, well, that's not going to be so good for valuations. Because yes, you have lived through the worst stock market in 50 years, but the earnings situation is still record high. What I mean by that is analysts have not dropped their expectations for company earnings throughout 2022. There is an argument to be made there. Well, maybe the stock market has already priced in bad earnings, and that's why stocks have dropped so much. And that is a very valid argument. Maybe that's why on Friday, financials outperformed every other segment of the stock market, rallying over 4%, even though banks had terrible earnings, with most banks' profits dropping in between 20 and 50% year over year. Maybe it's already priced into the markets. But what if it's not? As far as right now, analysts have not decreased their price targets for company earnings. That must be marked as a potential bearish thing throughout the rest of 2022. Now, this one is going to be obvious for everyone, but it is the Fed, and potentially the Fed not slowing down raising rates, potentially seeing a neutral rate in between 3.5% to 4.5%. Obviously, this will depend on the course of inflation. We have since seen some commodity prices come down, but we have also seen inflation branch out to more services, including dental and hospital visits, and also things like shelter. Now, I know a lot of people might think a recession is potentially a bearish thing, but a recession only changes the narrative because recessions bring about deflation. Companies cut prices. That is part and part why the price of oil is now under $100 a barrel, which it was above $100 a barrel for over 6 months, pretty much all of 2022 up until July, up until just the last week or two. Recessions equal slower growth, or potentially, right, a recession is negative growth. So people don't care about the Fed raising rates. People don't care about inflation, because why? The Fed will stop raising rates because inflation will fall off of a cliff. The narrative then becomes, once you enter a recession, how bad are company earnings going to be? How deep will this recession be? How long will it last? And that's the biggest question here, because as far as right now, we are expecting that we are already in a technical Wall Street recession, 2 quarters of declining GDP growth. Q1 2022 is finalized at a negative 1.6% GDP print. Right now, the Atlanta Fed GDP tracker has us at a negative 1.5% Q2 estimate. Well, we get the Fed raising rates July 27th. July 28th, we get advanced data for Q2 GDP, which roughly will be -1 to -1.5%. Hopefully not any worse than that. That might cause a little bit of fear. And then that whole week of July 29th, you have 30% of the S&P 500 that reports earnings, including Apple, Microsoft, Google, Amazon. You are over $1 trillion market cap companies, which by and large control the way the S&P and the NASDAQ trade. So That is potentially the bearish bullish scenario. The bullish scenario, meaning a recession, a slight technical recession, could actually be a bullish thing. And that is why the stock market has been rallying ever so slightly over the past couple of weeks, is because fears about a recession, potentially the Fed not raising rates as aggressively, and the fact that the 10-year treasury has been dropping, the yield has been falling, meaning investors have been buying the 10-year treasury, but they have also been selling short duration treasuries like the 2-year treasury. That's why you have the yield curve inversion that is now inverted 20 basis points, as high as 25 basis points at some points last week. You also have the probability of a 1% rate hike, which went from 10% last week to 80%, now down to 29%, because some Fed speakers have publicly came out, including Fed Bullard. They came out and said the yield curve inversion is a serious signal that he likes to look at. And also people like Fed Wallard that came out and said his base case scenario is a 75 basis point rate hike, and that 75 basis point rate hike will put us in between 2.25 to 2.5% on the federal funds rate, and that would be the neutral rate, indicating they do not want to raise rates 1%. They do not want to push us into a recession faster than we need to be. And like Fed Wallard said, people were actively quoting and saying that the Fed was not doing their job this whole year getting inflation down, but in all reality, they are raising rates at the fastest pace since the 80s to match what inflation is doing. So it's clear to see as of right now, there's a bearish case, but there is also a strong bullish case. And the biggest bullish point I want to stress to you guys here in this video is that we have already seen a lot of carnage in the broad markets. We have seen a lot of stocks down to their COVID crash lows, if not falling under those COVID crash lows. So potentially a lot of this fear is already baked into the actual share prices of a lot of these stocks. It's unfortunate that Apple, Microsoft, Google, Amazon, those stocks are going to control how the markets trade. So if those stocks have bad earnings, well, it's probably going to subject the markets to more downside. If those company earnings can be good, they don't even have to be great by any means. They could even be bad, but better than what people expect. That could be a very bullish thing. Think to what the banks did and what we previously said here in this video. Profits down 20 to 50% year over year. Not good, but those bank stocks were at their 52-week lows, some of them down to where the COVID crash bottoms were. So when you boil this all down into a nutshell, what do we expect throughout the rest of 2022? Or I should say, what do I expect throughout the rest of 2022? I still think there is going to be a flush out event. I think the fear of the Fed raising rates July 27th, if the Fed does not, this is a big if the Fed does not indicate that they are going to slow down raising rates, that is important. If the Fed comes out the 27th and they say, hey, we're probably going to stop raising rates here shortly, we are at the neutral level, we don't need to do more, then I think the markets rally off of that. That's the one most single bullish thing that once that happens, you want to be in equity markets. If there was one sign to look for, when the Fed pivots, when the Fed says, yeah, guys, we've raised rates enough for now, we're going to take a pause, that is when you want to jump back in the markets if you are already not in the markets. And I would expect to see a 3 to 4% positive day at least once the Fed says that. It could be July 27th, but it could be September 21st. That's the more bearish case. If the Fed just raises rates 75 basis points, they give us no inclination that they're going to stop raising rates. You get Q2 estimates for GDP coming the next day, which means we are in a technical recession. At the same time, Apple, Microsoft, Google, Amazon, these large cap companies miss earnings in a big way. Well, I think you could see a flush out event. Now, let's imagine we get negative Q2 GDP data. We get companies, the companies I just mentioned, that have bad earnings, but the Fed indicates that they're going to stop raising rates or at least slow down raising rates. That could still be a bullish thing. But if we get that worst case scenario, we get bad earnings, the Fed not indicating that they are going to slow down raising rates, as well as a technical recession, that's where you will see more downside in the markets. But I think it's quite possible, since what we heard from Fed Daly, Fed Bostic, Fed Bullard, Fed Wallard, that maybe we get a U-turn at the July 27th press conference. Maybe Jerome Powell comes out and he gives us an inclination that they will stop raising rates as aggressively. Just my thoughts. I still think there could be a flush out event, but I do think here over the next 30 days or so, you want to fully position yourself as if this is one of the last great buying opportunities that you guys will see over the next 10 or 20 years, because quite possibly it is the best buying opportunity that you will see in a very long time. So the bottom line to all of this, if there's one thing you pull out from this video, the most bullish thing that we are going to see, forget inflation, forget the Fed raising rates, forget company earnings, forget all of that. If you have been out of the market for 2022, you want to get into the markets when the Fed signals or says outright that they are going to stop raising rates or stop raising rates as aggressively. That is when the markets can slowly start to rebound until ultimately we're probably going into a recession, and then the Fed will cut rates, make money more accessible, aka cheaper interest rates. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys learned something from this video. Thank you guys for tuning in. Enjoy the rest of your weekends, and I will see you in the next one.